Folks, economic storm clouds are gathering, and that's the subject of tonight's riff. So yesterday, Fed Head Jay Powell issued pretty clear forward guidance that the central bank will start cutting its policy rate in September, and additional rate cuts might well occur in November and then December. Wall Street has been whining and panting for these rate cuts for about 2 years. So what does the stock market do? As Jerry Willis just reported, it got slammed down. Especially the high-tech NASDAQ lost almost 3% of its value, but the S&P 500 and the Dow got whacked hard as well. So what is going on here? Well, as I've often suggested, market bond yields are frequently more important than the Fed's target rate. And while the Fed has done nothing yet, most Treasury yields are down about 100 basis points in recent months. In other words, markets have been leading the Fed. And here's another key point. Lower market interest rates are surely a welcome development, yes, indeed, but the history shows that declining interest rates are also a recession indicator. And even though GDP has been growing at a sort of semi-stagnant 2%, a bunch of other indicators are flashing much bigger warning signs about the economic outlook. As Jerry Willis mentioned, today, for example, the reliable manufacturing report from the Institute of Supply Managers registered another deep dive, and they've dropped 7 out of the last 10 months. Meanwhile, inside the index under the hood, new orders, production, and employment all registered major declines. Plus, initial unemployment claims now working their way up and hitting nearly 250,000 for the most recent week. And don't forget, the unemployment rate itself has gone from 3.4% to 4.1% and may be headed still higher in tomorrow's jobs report. Meanwhile, consumer sentiment has been consistently poor. All manner of housing starts and sales have been in recession territory for a while. And even the mediocre 2% GDP, that's been held aloft by huge injections of government spending. So, is there a recession in the outlook? Well, that recession forecast was very wrong in 2023. But at the moment, the data suggests a much greater probability in the next 12 months. Yes, interest rates are likely to fall more, but be careful what you wish for, because that could foreshadow a big economic slump. Which brings me to election politics and policy. This is no time to raise taxes. Joe Biden and now Kamala Harris have both been talking about enormous tax hikes, totaling as much as $4 to $5 trillion. That would be sheer folly. Now, here's where Donald Trump has another major advantage. He's consistently talked about extending all of the Trump tax cuts launched in 2017. Lately, he has added to that by proposing tax-free tips for millions of waitresses, waiters, maitre d's, part-time workers, people in the gig economy, et cetera, et cetera. And just yesterday, Mr. Trump proposed to end the Social Security tax on retirees. Take a close look at these proposals. They all reduce the tax on work and employment. Also, they reduce the tax on business, investment, and productivity. Instead of spending a fortune on government deficits and borrowing, Trump is creating incentives to produce and innovate more. So, as economic storm clouds begin to gather, it is Mr. Trump who has the common sense solution to cut taxes and let people spend and invest more of their own money. Once again, advantage Trump. And that's the riff.